All right, I guess it's time to get going. Good morning. Hello, hello, hello. Oh, yeah. How's your mum? Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. My name is Wayne McDonald. I will be your guide on this journey we call Forex. Today we have some big central banking events. Lots of things going on based on macroeconomics and monetary policy. There's a lot that we can learn. So that's going to be the focus, in particular Wednesday. Yeah, Wednesday will be the Fed meeting. So if you're a member of FX Bootcamp, I think we should gather as a tribe and do the event and the press conference together. What do you stink? Smell like a plan? Yeah, it's what we do anyways, all the time, right? But yeah, cool. Sounds great. Right on. So compliments of the firm. Thank you for being a member of FX Bootcamp. And of course, I will make that available to video-only members, swing trading-only members, and day trading members. Everyone with a membership will be invited. Sweet! With that being said, now would be a great time to join FX Bootcamp. The link is in the description below the video. Or you can just type in fxbootcamp.com. Also in the description below, there's a training webinar. There's a training video on macroeconomics. Cool. Right on. And I'll show you 3 ways that you should be doing your fundamental analysis. I'll even show you my first trading strategy that I developed years ago that just happened to be quantitative because that's how the world was back then, and now is becoming once again. So anyways, that's in the description below. There's a link to tradersway.com, whom I believe to be a trustworthy, ethical foreign exchange broker with fast execution speed, narrow spreads, huge swaps, and above average good-looking people employed there. So you should check them out. We all need a broker. And I've seen many, but I've only used few. And I've been with Traders Way now for, I think, 8 years. Maybe 7, could be 8. It was just about the time of when the world almost slipped back into global recession. So maybe it was 2011, 2012. No, that'd be too many years ago. But anyways, it was when the Swiss National Bank lied to the world, and the markets were shocked. Imagine an 8,000 pip move in 1 minute. It broke the banks. It broke the brokers. People's accounts around the world were frozen because they had a mini lot trade that was negative $7,000, but they only had $2,000 in their account. Brokers went out of business. Big brokers went out of business. And Traders Way was perfectly fine. Why? They're an ECN. They don't hold the other side of your trade. They don't hold that risk. It goes into the interbanking system, and they actually did what they promised. And that turned out to be unique. So anyways, tradersway.com. By the way, boot camp. Noise. Noise. I hope you appreciate that I'm rocking the paisley today. I guess it's paisley. I don't know what you call it. So let's zip over to the long-term indices. And dollar still stable at our support, and yen collapsed. Now, we were looking for somewhat of a rally in Japanese yen, and it never quite emerged. But remember, there's a fundamental policy to weaken the Japanese yen, and it's been reaffirmed. So you have to now say, well, I'm trading the fundamentals, not the seasonality, the fundamentals. So we have a new regime, Ueda. Okay, Ueda's in charge. And yeah, so anyways, what was it, Thursday night? I guess it was Thursday night my time, Friday morning in Japan. They had their first press conference, and bada bing, bada boom. Oh yeah, thank you, David. I should mention that. Okay, I should mention that. Today, many banks around the world are closed due to May Day. I don't know what that is, but it sounds good. Mayday, Mayday. Abandoned ship. Anyway, so there's some sort of party. I think it's also International Women's Day. And I always thought that was this funny name because, like, well, I want to be an international woman. Domestic women don't count. It's International Women's Day. Well, screw you, domestic women. So anyways, yeah. Johnny says, First Republic, yeah. Oh, Labor Day everywhere else. Thank you. So Union Day. Union Day. But let me tell you, union workers, every day is Capitalist Day. Yeah. It's every day is Capitalist Day except for Tax Day. We call that May Day. So anyways, yeah. When do we do that here? I think that's the end of May, right? When we do Union Day. May the 4th is a pretty big one, Jim. May the 4th be with you. Oh, is that September? We do one at the end of May. I don't know. I'm an entrepreneur, so my entire career I hate holidays. It screws up work. See, I'm a capitalist pig dog. Anyways, Aussie's still coming down. Euro going back up. Remember, this is longer term charts, so that's good. It may not be today, but that is what's happening. Johnny's like Memorial Day. Okay, yes. Memorial Day, that's true. One experience I had a few years ago, I was at a Memorial Day parade. And after watching the parade, I had to get the kids a drink or something. They were hot, so I'm standing in line. And there's a kid next to me. And by kid, I don't know, 25 or something. But he's in his military uniform. And I'm staring and I'm staring and I'm staring. He's got like a star and a ribbon. And I'm like, holy crap, right? So anyways, I pinged my buddy David Pegler, who served in the military. And I'm like, what would that kid have? Like a ribbon and a star. And he's like, a kid. And Pegler's like, I don't know. A medal like that, you usually have to die. You have to usually save 20 people and die in the process. I'm like, that's what I thought. But I wouldn't even know how to ask somebody like that. But amazing anyways, pretty amazing. Oh, you're from Santa Barbara? Yeah, I know Santa Barbara well. Oh my God. My first time in the IV. I'm like, oh my God. Did somebody light that Volkswagen on fire? Oh my God. Santa Barbara, yeah. A lot of stories in Santa Barbara. Yeah. Yeah. Oh, Santa Barbara. Yeah. Oh my God. I even flew into Santa Barbara one time. Like, what? No, yeah, there's actually an airport. Anyways, let's take a look. IV is not safe. Yeah, man, that place was crazy. I remember one time I'm like, I need another beer. That front door is open. It's not even my house. It's not my friend's house. I have no idea whose house this is, but the front door's open. I walk in, there's people kind of crashed on the couches and a couple people laying on the floor, and there's a keg in the kitchen. And I'm like, hey, what's up? And they're like, hey, man. I walk into the kitchen, fill my cup with beer. I walk by and I'm like, hey, man, so who do I thank for this beer? And they're like, we don't know. I'm like, wait, this ain't your house? And they're like, no. And I'm like, oh, right on. Rock on, Garth. And I leave, right? I'm like, this place is funny, man. Santa Barbara's funny. Anyways, the IV, man. Good days. Good days. Good talk. All right. So anywho, my WTI. Yeah, boy. So we got the big giant up that we talked about on Thursday, Friday, and then it went straight up to our resistance. So then last night I'm like down to this line, and I drew this line. So now we're here at 75, and now what? I don't know. But I can tell you it matters, because what happens next depends on who's going to control this market. And then we would anticipate that would be what happens the rest of the week. So it'd probably get sort of one of these. Jim's like, I remember those days. Yep. Those were the days. Yep. And then someone put you in the other side of the world, huh? I would really like to visit Vietnam. I mean, I really would. I've told the kids and stuff too. Like, I want to get a junk boat floating around the waters of Vietnam. Yeah, yeah. You know, I suppose it's better when people aren't shooting at you, but yeah, actually, that would be just, I think, an epic experience. Go for a 20-mile hike through the jungle. Huh? Be a soldier for one day. One day. And nobody's shooting at you. But just to get a sense of just how hard it would have been to be a soldier on either side, really. And then I'm sure they have tours like, hey, you can go in this, underground tunnel into a bunker. I'm like, nope, not interested. Big hard pass. Hard pass. No, it's totally safe. There's a museum under there. You just got it. Nope, hard pass. But Vietnam looks like such an amazing place. Do you guys know Michael Covell? We were talking about him about a month ago, I think. We were talking about trend traders and turtle traders and all, that type of thing. Michael Covell was one of the guys that I believe was in one of the Market Wizards book, if I can remember that right. Maybe I'm totally wrong. But anyways, he packed up and moved to Vietnam 10 years ago. Just like, it's a better place to be. When you get sick of eating lunch at a restaurant that's in a parking lot with a view of a Lowe's and a Sleep Number shop, you're like, dude, this culture, right? Like, ugh. And so anyways, he packed up and he moved to Vietnam. And he's like, the average age of a person in Vietnam is like 22. It's young, it's vibrant, it's lively. The food's great. The cost of living's low. The healthcare is awesome. He just packed up and moved, and you got to give him credit for that. Anyways, I don't know the future here, guys. I don't know. It's going to be one of these. I can tell you what we do know, but we don't know how the market reacts after it. Like, for example, down here, that is an out. That's where you get out. Okay, here, this is an entry zone. This is an entry zone. So in a similar fashion, like back here on April 21st, we didn't know if it was going to go back to the top or if it was going to fall. See, you don't know that. So what you do... Okay, what you do is you decide, are you a bull or a bear? Bears sell here and here. Bulls could only buy there. That was the only price a bull ever had. That's how you set up your week, by the way. So this is a plan A sell for bears. This is a plan B sell for bears. This is a plan A for bulls, and nothing else exists as a swing trade. Now, technically, you can see, as I teach you in my book, that's a hard sell. The market is technically bearish. Okay? And so you could argue this. Now, you might be using other data to say you want to be a bull. Okay? And you would have to make that decision fundamentally, but this chart doesn't say that. Okay? Do fundamentals play any role? Absolutely. It's all fundamentals mixed in with emotions. There's very little logic. Well, oil's a beast, I'm telling you. It's your best friend, and then it'll stab you in the back. But yeah, it's heavy. It's really fascinating. Where to become you almost need to become a specialist in oil, or dumb it down so you ain't know nothing about no oil. Okay, it's tricky. So anyways, going back to basic technical analysis, we're at resistance here. The market is technically bearish, so selling it earlier would have been absolutely fine. Okay, now you might have fundamental rationale to say that this is going to turn bullish. Well, in that case, you wouldn't buy it down here. You could have bought it down here last week because we know that's a bearish out. A bearish out can turn into a bullish in. But then you're up here, that's not a bullish opportunity. Okay? So now for this week, this is your plan A, which is basically trend into a break. So now you're betting on something like this. And it quite literally is a bet because it hasn't happened yet. So it's not like you're trading something that you see. You're trading something you anticipate, and that could be dangerous. Your plan B would be here, which is a counter trend trade, but I'm trying to teach you to be a trend trader. So it's much more difficult this week to be a bull. Doesn't mean this won't happen. So what's the best way if you're a bull? Let it break, catch the dip, okay? Rock it. That's tough because that'll take a lot of patience. And you'll probably get that on Wednesday, but then the markets are going to be log jammed because of the FOMC. But, okay, this is very bearish, technically. So you have to say, what does it say? Really, we always ask ourselves three things, right? What does it say based on fundies? Okay. What does it say technically? Wow, I'm really struggling with the mouse today. What does it say technically? But then sentiment. Okay. So right now you see this big move down. That's I think largely to do with sentiment. Okay. Fundamentally, I would argue this is neither here nor there. It's neutral. I think fundamentally oil's neutral on the short term. Inventories have been coming down, but inventories are not low. You see? So like, okay, so what if they become low and inventories become low enough relative to demand, price will start to increase. But that hasn't happened yet. But sentiment is very bearish because we are suddenly pricing in a recession, which would lower demand. And even if we have, let's say, an average level of supply, which is true, but with below average demand, prices would need to come down. So we're really playing this out. Recession or no recession. Is or is you ain't my baby. Are we or are we not going into recession? Maida says, yeah, about Cinco de Mayo. I don't think Mexicans care that much. Like in Mexico, they're like, what, it's like a holiday to sell tacos and Coronas. But you get to Mexico and they're like, whatever. It's more of an American holiday, I think. And if I'm wrong on that, I apologize. I don't mean to be offensive. Oh, Stingray, that's interesting. Maybe, huh? Or maybe it was Dad or somebody too. It could have been, right? Yeah, yeah, thanks for pondering that. Maybe. But, and I believe if I remember correctly, he was a Marine. So a 25-year-old Marine with a rifle can do it. Okay, gold trying, huh? Testing. It's testing. Ooh, that looks good. Now we're on the 2K. We're on the 2K again, but 1981 predicts 2016. Ooh la la. But if you're buying in May and going away, as you can see, I've already drawn, but we're on our way to basically almost 21, as high as 21. Okay, another $100 up. Just got to get through 2,000. If we get through 2,000, we can go to 2,100. It wouldn't be this week, by the way. Okay, Richard asks an astute question. What fundamentals do we look for gold? Aggregate demand or inflation? Okay, so here's, right? So you look at nominal versus real. Okay. All right. So let's say we have 5% interest rates. Okay. But we have 6% inflation. Okay. What does that do? So that gives us a negative real rate. And gold goes up. Okay? The value of your dollar is still providing a negative performance. Your cash is losing money, Richard. So therefore, you got to convert your paper money into a real asset because real returns are negative. Okay. And Richard says because it's used as a hedge. Yeah, but just think of it. It's not, yes, I mean, but I don't think people, most regular souls on earth are not sitting there thinking, I need to hedge my money, so I need to buy gold. Most people, okay, but they know their money doesn't perform well just sitting in a bank doing something, right, and doing nothing. And prices are going up, and then they look at their bank account, and the bank account's not going up. So they know they need to spend their money. Okay? You have to convert your money into a real asset. And one of those real assets is gold. Yeah. Now, let's say if you were a millionaire, not a billionaire, but let's say you could scrounge up a few M if you needed it. I wouldn't recommend you buy gold, but I would start looking for apartment buildings that are struggling to roll over their mortgages at higher mortgage rates. So you find a really good property in a really good city with a really good long-term outlook in a really good neighborhood. But essentially, when money was free, the owner pulled out too much equity, put it in his pocket, because his mortgage was only 4%. Now he has to roll it over, and now it's 6.5, and he doesn't have that liquidity. He spent his money. He bought yachts and jets and bought whatever, but he ain't got enough money now, right? So now you can become that partner that can buy into a property that's already purchased, developed, already they've done all the marketing, they've filled all the apartments with renters. The guy has done everything right except manage money. Doesn't understand economics. He might know how to get a loan and buy an apartment building, but doesn't know anything about global economics like you do. So you're like, oh, now someone else has done all the work, and you help them get that new mortgage, and you get a nice, fat, healthy piece of the equity. So what has happened there? Well, you've converted cash into a real asset. You're not buying a ski boat or a bass boat. You're not buying a TV. You're not buying a car. You bought equity into a cash flow. An apartment is not a building. It's a cash flow. It's just math. Okay? In many cases, you don't even need to look at the apartment building. You're like, give me all the numbers. I'll pop it into an Excel spreadsheet. I'll do my calculations, and I'll give you my number based on all the way down to the penny. Here's what I'll invest. Here's what I expect to get in return. And it's a yes or no question. Do you want me to invest, or am I walking? Okay. So anyway, so that's the idea, right? Convert your cash into a real asset. Now, why not gold? It doesn't produce any income. It's a store of value, but it's a terrible medium of exchange. Okay? You could use it as a unit of account, I guess. How many ounces of gold is your house worth? How many ounces of gold do you have in your retirement account? I guess you could use it as a unit of account. You could use it as a store of value, but it's a terrible medium of exchange. And it doesn't provide any income. In fact, if you owned physical gold, you would have to spend money to store it securely. So it actually guarantees you a negative cash flow, but the asset still might appreciate. I'd rather have the apartment building because it provides cash flow and asset appreciation. But the asset appreciation is irrelevant. It's really the cash flow. Maida, I think that's a mindset. If you give a moment of thanks and gratitude, like the idea that freedom isn't free, in the South, you can just be driving down a country road and you'll see signs like that. And it's a really good reminder. This is a cush, easy life. What a cush, easy life. But I'm well aware that someone had to stand their ground for capitalism and democracy. Someone had to stand their ground, for sure. And like I said, we were talking about David Pegler. He stood his ground for America to become an American citizen. It's an incredible way to earn your right, huh? It's an incredible way to earn your right. He fought in Iraq for the U.S. Army as a South African. It's amazing. Jim, in Canada, we do Remembrance Day, November 11th, in remembrance of World War I. And everyone wears poppies. Even as a kid in elementary school, they thought, I mean, this is how much the world has changed. Imagine you have a group of 30 10-year-olds. And you hand out poppies, red flowers attached to a sharp pin. And you pin it to their shirts. There's no way that would go down. You can't even get through TSA with something like that. You might take down the airplane with that weapon. You used to hand it out to elementary kids, right? Oh, they're like, the teachers are going to be, well, what if they poke each other in the eye? You're like, dude, we live in such a funny world now, huh? So I don't know what they probably don't even hand that out. Kids were just fine. I don't remember anyone poking their eyes out with a pin. Anyways. Wow, look at our gold. It's just cray-cray, dude. Cray-cray. Now, can it get through? 2007 is a big number. The top of the market is supposed to be, for the week, I don't know, 2020? Not quite 2020. And then profit taking. Wow, what an interesting day. That's good. That's the dollar weakness. Yep, that's risk on. That would probably start to push the stock market up today when it opens. Notice it's kicking off the 1H21. Actually, that might not even be the 21. Yeah, it is the 21. Cool. So that's a bullish day, boy. That's a bullish day, boy. Look at that, right off that line. Wow, that's cool. Yeah, Lucas. Oh, man, it's such a part of Canadian history. There's two things I remember as a child in Canada. One, playing street hockey and a car comes along. Car! Car! And you move the net and everything, and everybody gets out of the way. And the car drives by. Game on! Game on! And the other one is, you're dead, man. You're dead. After school, 3:30 behind the rink. You're dead, man. You're dead, eh? Yeah, meet 3:30 behind the hockey rink, and you get there and the whole entire school is there. And for some reason, none of the teachers know this is going down. How can 330 kids know there's a fight at 3:30 behind the rink and not one adult knows? You know, they're laughing like, that kid's a jerk anyway. Someone should beat the crap out of him. We'd have some awesome fights. And awesome fights. Yeah, ain't no more. Now you got to bring a gun to school? How cowardice. Okay, anyway, so that's a big, bold risk on. I almost don't believe it. Don't believe the hype. But what would be doing this? What, like the First Republic deal? Oh my God. Boy, did JP Morgan score on that. Like, that was so well played. I would give Jamie Dimon enough credit to say that pre-bailout where he got 12 other banks together was a part of the original strategy. Like, I think he's that good where they were sitting around going, all right, we need to pick up First Republic. And then they're like, you know what, Mr. Dimon? There's no way they're going to allow that to happen because we're the biggest bank in the United States, well beyond too big to fail. Like, there's a rule, like JP Morgan, because it has more than 10%. Listen to this. JP Morgan has more than 10% of all the accounts in the United States as a bank. At least 10% of Americans are at JP Morgan. So they're not even allowed by law to buy a competitor because they could just use all their money and buy up all the competition and be even bigger. And then, you know, so they're not even allowed by law. So they're like, Mr. Dimon, we don't think you're going to be allowed to buy First Republic because of that rule. And he's like, oh, you're right. So we got to get them to bend the rule. So let's do this. Let's make sure the bank doesn't go out of business. We'll call it systemic risk. We'll get 11 other banks to chip in. We'll lead the whole thing. We'll be in good light. And then if it goes into bankruptcy receivership, then we will look good and we will be able to break the rule. And anyways, that's what happened. Now, Richard says he bailed the United States out. Now, I was listening to Bloomberg this morning, and one of the commentators made a similar remark. Now, here's the funniest thing. If you're a financial historian, the irony is that the Federal Reserve Bank of the United States, as we know it, which is, I think, the third iteration of a central bank. The first two failed. The Fed was created by JP Morgan. Not the company, the man. Now, yes, there was a bank, and that was actually started by JP Morgan's father. And remember, there was no central bank of the United States at that time. So JP Morgan's father, as an American, sat on the board of directors for the Bank of England. He was a central banker to the UK, but the United States didn't have a central bank. But now JP Morgan, the son, who then ran all the businesses for his dad, right? Because dad was retired and doing more diplomatic type stuff. JP Morgan was the one that was putting money into electricity, funding Tesla. Not Tesla. Tesla. Nikolai. Oh, I can't do that now. Yet. But he was running all these banks, and he had a personal fortune as well that was massive. Think of like Elon Musk of the time, which is funny because of Tesla, right? Nikola, right? So anyways, the United States kind of defaulted, even though we always say they haven't defaulted. Technically, it's happened at least once or twice. One time the United States defaulted because there was a computer error. And they're like, no, that was a computer error. Well, you missed payments. That's a default. But there was this time when the United States, in JP Morgan's time, was on the brink of collapse and default. And they turned to JP Morgan, the man, not the bank. And he bailed out the government. Personally. But part of this led to the creation of the Federal Reserve Bank, which happened in Jekyll Island, Georgia. And to think about how powerful this was, the first interstate telephone lines, there was 2 interstate telephone lines built at the same time. One from Wall Street to Jekyll Island, Georgia, and the second one was from Washington, D.C. to Jekyll Island, Georgia. That's how powerful this dude was. And so he had his little hunting club, and he was able to call Wall Street, which is the money, and then he can call Washington, D.C., which is power. He had direct access to money and power. Yeah. And so I've actually been in the room, the same room the Federal Reserve Bank was created, and I've actually stayed in the penthouse where JP Morgan stayed all the time when he created the Fed. And the night I stayed there was occupied the night before by Ben Bernanke. So it's weird. I've slept in the same bed as Ben Bernanke. Just, one night apart, but still. Now, the most cool thing of this whole story, in my opinion, was this penthouse has a spiral staircase that goes up to a turret-shaped roof, kind of like a lighthouse. I went up the staircase and I went outside the windows, and I'm up on the roof, hanging out there with JP Morgan's ghost. I felt him. And I sat there and I smoked a cigar in JP Morgan's room the night after Ben Bernanke was there. Tell you, I geeked out. What a nerd. What a nerd. I'll see if I can get a picture for you so you can see it. Here we go. There it is. See? See this thing right there? This was, oops, let me do it this way. This is my room. Ooh! And so I was way up here, and I sat up here all by myself, because the only way in is through my bedroom. Just me and JP Morgan's ghost. I was so excited. Like a kid. So I've always wanted to go back here. And look, I'm telling you how geeky I was. You see here, this is a croquet lawn. I brought my V sweater vest with the stripes, and I brought white pants, and I signed up for the cricket, and my wife's like, no, don't do it. But anyways, I think we should get together, because like literally, if I can draw this, right through these doors and right there is the room the Federal Reserve Bank was created. I think we should get together, and I've proposed this multiple times. Maybe one day, if I say it enough times, we can do this. I propose you fly into Jacksonville, Florida, and we take a bus to the Jekyll Island Hotel, and we stay there for a night, and I teach you about the history of the Federal Reserve. In the Federal Reserve boardroom. And we'll have mint juleps, and there's a nice little pool, and we can do croquet, and we can go for a nice bicycle ride, and the beach is not far away, and we can have a really nice day of it, and of course the whole thing's a tax write-off. Day 2, we get on the train at night and work our way to Washington, D.C., in which we wake up the next day and we work our way to the Federal Reserve building in Washington, D.C. And maybe we arrange for a tour so we can go into the room where they actually do the FOMC meetings. Actually see the table in which they do the FOMC meetings. And I can show you a picture of that. Okay, here it is. So we go to that room. And we'll hang out in the Willard Hotel. And we'll have cocktails in the bar across the street from the White House. Why would I do that? Because the President of the United States, I forget which one, right after the Civil War, maybe it was Grant. I think it was Grant. His wife wouldn't let him smoke cigars in the White House, so he would walk across the street to the Willard Hotel, go into the lobby bar and drink, because remember, before he became a general and before he became the President of the United States, he was a raging alcoholic. So anyway, he'd go to the Willard Hotel, throw back 5 or 6 whiskeys, smoke his cigars, and guess what? People found out about this. So people that needed a favor from the president would just go there and buy him drinks and cigars in the lobby of the Willard Hotel, aka lobbyists. Oh my God, that's so awesome. Then we get on a train the next day or the next night or whatever, and we work our way to New York City, where we go to the New York Fed, where they have the Forex trading desk and the vault of gold, theoretically. And we get a tour of the New York Fed, where the dealing desk is, where they buy and sell all the treasuries to actually change the interest rates in the United States. Is that the term originated? Yes, lobbyists. They would meet President Grant in the lobby of the Willard Hotel to seek his favors, to sit there, and they can drink all night, smoke all night, and they can talk about what they thought was important. Oh, this new bill coming up. Oh, well, what are they thinking? That's crazy. That's bad for America. Yeah, so I think we should do this. I came up with the idea about, 20 years ago. But I think we should do it. Take the train and everything, because that's how they got to Jekyll Island. There's nothing out there. There's nothing. Jekyll Island is not near anything. It never was. It's amazing that all that history is there, and nobody gives a hoot. But I do, and I love it. So anyways, I geek out on this stuff. I would do it. But we'd need what? At the very least, let's say a Greyhound bus. How many people is that? 30? So I can pick you up at the airport. We can go to Jekyll Island, and then we can have the bus drop us off at the train station, and then we go to to DC, and then a bus has to take us, and we got to go, check in at the Willard Hotel, walk or get driven to the Federal Reserve building, which is across the street from the Vietnam Memorial, and you can see the Lincoln Memorial. Yeah, I guess it's Lincoln Memorial. No, not the one on the water, the one at the end of the mall. Anyways, we can have a cool 3 days, huh? So yeah, you'd fly into Jacksonville, yeah. But it's not near Jacksonville. I mean, it's a good 40-minute drive from Jacksonville, Maida. So it's not like you would just, you wouldn't go back and forth. But so anyways, I can set that stuff up. I just, we just need to do it. I never have enough time to do all these things. So anyways, gold, Oscar Mike, that's really interesting. You would think S&P 500 up on that. It's kind of hard because everything's closed, right? So thin market trading. This is one that we looked at last night, and we talked about, like, if there were bears. Let me do this in blue. Again, last night in the day trading group, you should join. We meet on Sundays, bro. Okay. So we said last night, we're right here. And it was like, if there are bears, they would sell. And then we talked about it fundamentally. What speech did I give? Anything come to mind? I was speech heavy yesterday. Speech heavy. Moo trades, yeah. Especially on the day trading. Any other analogies? I think I did probably 3 different analogies, but one of them explained the moo trade. Has to do with monetary policy announcements by a central bank. See, I told you, we're lucky if we remember 2%. Okay? I remember because I gave the speeches. Okay, how about financial tsunami? How about rats fleeing a sinking ship? So that's 3. So that's good enough. Yeah, but that's not an analogy, right, Richard? So anyways, there you go. And sure enough, okay, we can then look at yens. Is that right, Lucas? You imagine all the people that are not boot campers, right? They're like, wait, what? The cows on the fence? Rats fleeing a sinking ship? A tsunami? Moo trades? You're like, oh my God. Yeah, well, if somebody remembers any of them, then it's time well spent. So, all yens up. All yens up. Here's this one. So, where's my entry? Just under that. So, I'm in at 133.5, and we're at 136.5. I'm up 320 pips. Oh, God. Oh, God. 320 pips. I'm supposed to take profit. Nah, forget it. Let it run, baby. I'm going to run to you when the feeling's right. I'm going to trade all night. I'm going to run to you. Now, Jim and Lucas are laughing at the cow story, but I have to reiterate for everybody, I've been telling that cow story in the same circumstance for 20 years. Right? Which means these are repeatable. Once you know the lesson, you know it for life. which means it's a skill. Not telling the stories, that might be a skill too, but the skill is if you know and you can apply what you know, then it becomes a skill. You know, like for example, I had my family in Venice a month ago or something like that. And in all the tour guides, they all say, go to this cicchetti place because you can get some cicchetti. And then while you eat, on the other side of the canal, there's this place where they still make and repair gondolas. And that's why you go there. So you get your food and you sit outside and you stare at them. Look, that's the place, the last remaining place in Venice where they make and repair gondolas by hand. I'm like, that's cool. So I contacted them. I'm like, I'm fascinated by your history. Will you, if we show up at your front door, will you show us around? And they're like, well, we don't sell tickets. We're not really a touristy place. Like, we don't really. Okay, if you give us a tip, we'll do it. So yeah, I took my whole family and we went inside and we watched people with skill. The last remaining, and it's all family. It's like the woman that showed us around, it was her. She's worked there her whole life. And her 3 brothers and her dad. And they're the last remaining family to manufacture and repair gondolas that go through the canals of Venice. Isn't that sweet? A real skill. Something that's applied. They were putting like this tar paint on the bottoms, but I saw them manufacturing it. They used something like, it was crazy, like 7 different types of wood. And so I looked, and I talked about this because they need flexibility this way, but they need stiffness that way. And it's not even built straight. It's built crooked because, well, the gondolier stands on one side, so that would turn the thing. So it's made with a twist in it to counterbalance the gondolier. And it's so fascinating. They're seasoning wood. They're like, we're going to use this wood next year to make and repair gondolas and all that kind of stuff. My point is, it's an appreciable skill. Yeah, and it was great to see this family doing it, of course, right, Jim? Right, just amazing. But what I'm trying to impart is I'm trying to give you a real skill. I'm trying to destroy the pie in the sky dreams and fantasies and mirages that fill our industry. And replace that with an appreciable skill that is sustainable as a business. So if I can get you to remember a lesson like using those analogies last night, then you can convert that into a skill. If you can't remember it, then you can't convert it to a skill. You just can't. On says, hey, Wayne, what metrics do you look at when deciding to buy a stock? Well, that depends. So the stock fund that I'm creating now is different from other types of scenarios, right? So like I'm building a service that builds endowments for regular people. So what does an endowment need? Well, the whole point of an endowment, at least in design or philosophy, like it may not actually be true for individual people, but what if the money was managed like it's an endowment? Well, then what's the goal of the endowment? Okay, to earn income right? Why does it need to earn income? Well, if it's a charitable endowment and a wealthy person has $100 million, you can say, well, okay, manage this $100 million like an endowment. It'll earn income. So let's say it earns $5 million a week or a year, $5 million a year. It says, okay, you earn $5 million a year because it's invested conservatively, and this $5 million is now available to donate to charity. So the endowment donates $5 million to charity. How much money is left over at the end of the year? $100 million. So Richard says, yeah, that's for schools, for universities, for the arts, for museums, and for charitable, wealthy individuals or wealthy families, sometimes spurred by tax problems, and say, well, I don't want to give $100 million to the government, so I'm going to give $100 million to a charitable endowment or a charitable trust. But the money goes to charity. But you don't give $100 million to charity. Okay? You invest it conservatively, and the income it earns is given to charity. And what happens is the money is forever. It's forever money. Okay? So, if I were on saying, well, what do I look for when deciding to buy a stock? Well, the idea that you have to manage this money and keep it forever, you're going to want low volatility. Okay? Otherwise known as low, instead of volatility, because you're looking at things as an aggregate, you're looking at systemic risk, you want low beta. Remember, what is alpha? Your ability to outbeat the market. Do you understand? How you can be smarter and make more money than the market, beat the market. Anything above beta is you, but very often the way you beat the market is by taking on risk. Well, whoa. I want this money to last forever. I don't want the risk. So I'm not trying to beat the market, which is alpha. I actually want lower beta. Beta is the market. I want to have less volatility than the market. So I want low beta, and then have strategies directly or indirectly through the purchase of the development or construction of the portfolio, right, to earn income. Because there are two prime directives. There's a dual mandate. Have a low volatility portfolio that earns consistent income. Does that sound familiar to anybody? That's what I've been preaching to you as Forex traders for over 20 years. You want low volatility with consistent returns. So, of course, it's hedged. That's how you do it. Okay? Now, you see on, so if I'm like, okay, you start with your goals, I guess is what I'm saying on. Now, your goals might be different. Okay? So let's look at this now more esoterically, where we say growth. Okay? You want asset appreciation. Sorry, I was thinking with the next one. Okay. And you want high alpha. Okay. So mine was low beta, consistent returns, or no, low beta and income. Now, On might come to me and say, Wayne, could you construct a portfolio for me? And I'll say, okay, well, let's start with your goals. What do you want to achieve, On? And you're like, boom, I want high alpha asset appreciation. You want me to buy stocks low and then have them rally like crazy. Okay, so a different goal here. Now, let's say whatever happens, we have to choose between stock indices. Okay? If I were to invest this endowment money, would I invest into NASDAQ or S&P 500? Oh, Lucas, I noticed your comment there on Damascus Steel. Yeah, me too. That's right, S&P 500. Why? Oops. It has a lower beta. Okay, now by contrast, should I invest into, when it comes to growth, should I invest into NASDAQ or S&P 500? Well, NASI, right? It has a higher beta, higher alpha, or actually higher beta, which will, relative to this one, give you a higher alpha if you get it right. The consequence to it is it's higher risk. Yes, you might be able to buy, Okay, so anyways, so looking at that, this one would be more appropriate for growth. Now, S&P 500 may not be the best choice, but relative to the NASDAQ, okay, this is how you'd split it. Okay? So it depends on what your goal is. Now, I think NASI is actually a little more expensive and a few other things. But that's one way of looking at it. So I'm not giving you a direct answer per stock, but it'd be like, I made some investments like I'm a venture capitalist, but more of my, now I'm investing my personal money like an endowment. Okay? So there's another way of doing this. So let's try to achieve this. Now I'm only looking at, I can only buy this aggregate. And how would Bill Sharp teach me how to manage this? How would Bill Sharp mentor me as a fund manager? Now, here's the interesting thing. You can ask, let's say, ask any MBA managing $100 million or more. And I bet you they wouldn't know this. Even if there's an MBA, PhD, quant, managing $1 billion. I bet you they don't know this basic fact. Now, every single day, these guys that are managing money are critiqued based on their Sharpe ratio. And they're very, very familiar of the Sharpe ratio. Everybody knows the Sharpe ratio. The thing is, they don't understand the concept. And the concept isn't really taught at school. So they're like, all people know is Sharpe above 1, great. Sharpe below 1, not great. And that's that. But why did Bill Sharp do this? Why did he win the Nobel Prize? Oh, well, nobody knows that. Okay. So here's what he said. Buy the S&P 500. It's the cheapest. you're actually buying the beta. You don't have high beta, you don't have low beta, there's no alpha, but it doesn't matter because on the long run, you will produce the best returns just simply buying the S&P 500. And it's by far the cheapest. It's already diversified. So you don't need to try to beat the market. Don't even try. But there is a way to do it. And you're like, ooh, tell me, Bill Sharp, Nobel Prize winning economist. Okay, you have your principal investment, aka your portfolio in the S&P 500. Okay, cool. When you enter times that are expected to be bad, you're entering a recession. Okay, when the market's still good, remember now you still have to make the decision like, ooh, we might be entering recession. Okay, so you say, I'm going to go to 50% cash. Okay, now your risk exposure is dropped by 50%. Simple enough. You have half the beta. The S&P 500 might drop 20%, but you've only lost 10%. And now you have cash to buy back in when the drop is over. And you reinvest that cash back into the S&P 500, but at a lower price. So let's say the S&P 500 drops from 4,000 to 3,000. Okay, so at 4,000, you go to 50% cash. At 3,000, you buy back in. And on the long run, you're tickled pink. It was cheap. It was easy, completely diversified. Okay, cool. That's smart. But then when you think things are good, how do you beat the market using the S&P 500? Oh, you deploy some leverage. And then when the market goes neutral and the bubble is sort of fully blown, right? Fully, it hasn't blown up. How do you say not blown up, meaning over, but fully expanded? You're like, whoa, dude, look at that. Everything's at 25 times earnings. Take the leverage off, go back neutral, and sit on it for a year or two. And then when it starts to show signs of weakness and it's going to go drop, change your portfolio to add some cash. And that's all you need to do. Okay? But it won't achieve the same as my endowment fund. Okay? But check this. So that's one way to beat the market, to be partially hedged on the way down and partially leveraged on the way up. You'll always beat the average idiot managing money. You'll beat, oh my God, you'll beat 90% of the market. Professionals. Just, right? Cheap and easy, man. Cheap and easy. But of course, if you don't have the knowledge, it ain't going to happen. So, Bill Sharp won the Nobel Prize. Everybody knows it. Everybody uses the Sharp ratio, but nobody knows what he said. So I'd like to thank Harvard for letting me know. I appreciate that. Okay, so how can I apply this to an endowment fund? Going back to now goals. See, I keep going back. Goals. It depends on the goals. You start with the goals and then you create the strategy. And from the strategy, you construct your portfolio to achieve your goals. It's a business plan. Okay? So I look at this, I'm like, okay, I want low vol, I want low beta, and I want to earn income, but obviously I'd like some upside. Remember this, the money lasts forever, but isn't there a hidden goal like this? Okay, like, think of it this way. If I'm hedged, when things go down, I'll outperform and you'll love me. because the market will drop 20% and we'll be fine because I'm earning income. Now, if you own Peloton, it doesn't pay you any income, but it drops 75%. So all you have is volatility and asset appreciation, where I'm removing the volatility and I don't really care. As far as my objectives, my dual mandate, it doesn't say anything about buy a stock cheap and have it appreciate. That's not the point. So I only want to buy good, stable, profitable companies that are mature, that have market share, that have price control. I don't want a boom and bust. I don't want that at all, right? So how do I handle this? But at the end of the day, if the stock market goes up, right? If I just do this model, the problem is that the stock market might be up 20%. Now, because I'm hedged, remember I have low volatility. Well, I might, right? The stock market, the S&P 500 might be up 20%. I might only be up 13%. Or 15%. I'll put 15. That's probably more realistic. I'll underperform on asset appreciation because remember, I'm hedging. So I have my cost of hedging. So my portfolio might be up 20%, but then I got my cost of hedging. Hedging reduces the volatility, lowers the beta. So a consequence of less risk is that when times are great, remember, the stock market's up 20% because there are companies that don't have any profits that are up 200% for the year. Well, I'm not buying those. Okay, you see? Because I want the lower beta. I don't want high beta. So I'll never have the huge, amazing years because that's not the point. I want the money to live forever. I don't want boom and bust. There's quite something. So what could I do? This is what I'm getting at. And once again, I'm answering a question where you start with your goal. How do you pick a stock? Well, what's the goal of picking the stock? Are you acting like a venture capitalist? Do you want high dividends? Do you want one that's going to quadruple? Or do you just want a steady Freddy, only a blue chip? Are you going to buy Microsoft? Or are you going to buy Peloton? It depends, right? So I think about this in portfolio construction. I'm like, okay, I do want the asset appreciation if I can get it. So how do I get it without really dramatically increasing my exposure to risk? Well, when times are good, and how do I know that? Well, I'm an economist and I understand monetary policy. So the Fed will tell me, for example. And when times are good, guess what I'm going to do? Instead of building and constructing a portfolio around S&P 500 companies, I look for similar companies, not Pelotons, but mature, profitable companies that have market share in a growing industry. So there's demand to own these companies, which is how you appreciate. And now it's constructed around NASDAQ type companies. So maybe I do buy Apple, and Google, and Microsoft, and Netflix, and Nvidia type companies because they are moving. And because of just the change in construction of portfolio into, profitable companies, maybe I get the asset appreciation up 20%. But the thing is, I'll only do it if I can continue to earn my income. Because the prime directive is I want to earn 10 to 12% a year in income. which means I don't actually, if I construct my portfolio correctly, I don't really care about net asset value of the stocks I own because I'm going to own them forever. Now, the truth is, when you elect to retire, you call me up. You're like, Wayne, thank you. You have $3 million of my money in your account. I'd like to start being paid the income. So I'm like, okay, I'll start paying you $25,000 a month. Is that cool? Yeah, so your net asset value should always remain the same. That's your forever. But then you call me up 10 years later and it turns out you have cancer. And they're like, Wayne, I need that $3 million. And I'm like, okay, well, it's your money. You might not live forever, but it's possible that your money can live forever like an endowment. But the thing is, until you get to retirement, I don't want you to touch it, right? So anyway, so that's that's your question is portfolio construction on what goes into stock selection. Well, you have to start with what your goal is. So I do own in my personal retirement account, I own things like I considered it a venture capital type thing. I'll take the high volatility, but I'm going to sit on it for 20 years, and I expect either to have zero at the end or 1,000% return. You have to remember, I used to be a venture capitalist, so that's right. But then there's others like asset appreciation. You're like, this stock is really on a tear. It's really growing. It's up 40% this year. Okay, well, that's a growth issue. That's a growth target. You're like, I want high growth, and you're trying to beat the market by picking the fastest moving stocks. Okay, that's fine. Does that match with the business cycle that we're in now and the monetary policy of the central bank? It could be, maybe not. But in that case, if the economy shows high risk and that there's monetary policy is such that it's contracting the market and maybe creating a recession, you could argue that growth is not the right thing to be in particular, anything that's not a FANG or whatever they call them all now. You might say, well, I want something a little more consistent. Like if we go into recession, I might want something else. And it would start with that goal first. Okay, so An says, okay, early retirement and outperform hedge funds. All right, so you are probably heavy on the alpha. So you need stocks that are going to go up 30% this year, right? See, I don't want to say that. Like in my fund, I would say no matter what happens in the stock market, okay, no matter what happens, the stocks might be up 20% because it's a good year. Stocks might be down 20% because it's a bad year. Okay? But on the long run, 10 years from now, stocks will be up. Okay? So you could have up this year and then down for 2 years, and then you can have up and then a down and then an up, and we both agree that we're here now, but in 10, 20 years, we're going to be here. And there's ups and downs along the way. What I'm trying to say with my portfolio construction is I agree with you. I think everything will be higher in 20 years. And I believe the up and down I can neutralize. So I can be essentially, like, it's not true, but like market neutral. I can, through hedging and proper portfolio construction, I can neutralize that on the long run. And just every year, add 10% to your account. In income, though, like this is like a carry trade. So in a bad year, your stock portfolio, which is the one I constructed for your retirement account, might be down 10%. Which means everyone else is probably down 15%. But because I have hedging and all that going on, you're only down 10%, which sucks. But irregardless of the value of the portfolio being down, you still got 10% income. Like a carry trade, it doesn't matter if the USD yen goes up or down today, you're going to collect a carry. It's just, that's it. You're no matter what. So at the end of the year, you're like, oh man, the portfolio's down 10%, but you collected 10%. So in real terms, nothing happened, but you got the income. And the cool thing is if you reinvest it, you're buying the stock market low. And then in a good year, it goes up 10%. Sweet. Well, you still get your 10% on top of the 10%. So there's almost like a catch-up effect, you see? And my goal is this. If I can keep this steady and keep this flat, okay, so low volatility and consistent returns, I will create the most boring, consistent portfolio in the world. I think it's the smartest thing ever. Well, at least for a supermodel like myself. Okay? But that would be the objective. Okay? So, like, again, if you had $1 million in the account, you're like, oh, man, the stock market's down 15% this year. How are we doing? Oh, we're down 10%. You're like, oh, that's terrible. Meanwhile, every month I give you $10,000. You're like, yeah, that's really sucks. Where's my $10,000? Every month. Here you go. January, 10,000. February, 10,000. In your pocket. You're retired. You're like, now you're golfing. And your buddies are like, man, the markets are killing my account, my portfolio. You're like, yeah, it's terrible. I still make, and you're thinking, you're laughing because you're making $10,000 a month. You're like, yeah, it's down. Yeah, that's terrible. Bum, money in the bank. Income. Because it's like you own an apartment building. The value of the building goes up or down. You don't really see it. You don't really look at it. It's not real. The apartment building doesn't change. On paper, it goes up and down, up and down, up and down. You're like, yep, but every month you're collecting rent, pocketing the profit. Okay? That's what I want, and that's my goal. That's pretty sweet, though, isn't it? So anyways, quick little speech on portfolio construction. Thank you, everybody. I hope that answered your question, on, and I hope everybody else clicked the thumbs up button. So, yeah, risk on would be good for exotics. But honestly, on that, like going into like Bill Sharp portfolio construction theories and stuff, like that's beyond even most college classes because even the professor doesn't get it. They don't invest, they teach. So they read a book, a textbook, and the textbook says, give the lecture this way. And they go out and they give the lecture, and so they say, well, there's volatility over return, but then you want real return, so then you can put in the yield of the 10-year T-note to subtract that from return, so you get real return. So the stock market is up 10%, but the yield is 3%, so the real return is only 7%. Divide that by the volatility of the overall portfolio, and you get your Sharpe ratio, and that shows you the level of risk that you obtained relative to the opportunity cost. And everyone's like, oh, great, so you outperformed without taking risk-adjusted performance. And it's the least interesting part of everything he said. Because the Sharpe ratio is cool. So to compare a Forex fund with a stock fund, with a real estate fund, with a crypto fund, which one do you invest in? Well, one of them has $1 million, the other one has $100 million, the other one has $22 million. right? Like, and they're all different asset classes, and they all have different levels of risk. Which one do you invest in? The first thing you do is calculate the Sharpe ratio, which is risk-adjusted performance, so you can find out who has the best performance relative to the risk they took to gain the performance, which is volatility, by the way, how much volatility accompanied these investments. And so at the end of it, what you've tried to do is, now they're not 4 different funds, they're all apples. So which apples produce the best apple pie? And you're like, crypto, too much volatility for its return. Now, the absolute return might have been higher, but not the best. And so you might go through it and you're like, well, the real estate fund had the second highest absolute return, but it was the most consistent, the lowest volatility. So for dollar, risk for risk, okay, you're best to go with the real estate fund, even though it's way different than all these other funds, a Forex fund, a stock fund, there's a real estate fund, the crypto fund, but per unit of risk, the real estate gave you the highest reward. Okay, great. Very useful, very helpful. But that's only a very small part of what he was saying. How do you achieve that kind of return when constructing a portfolio of, let's say, the stock market? And even though the people that are taught the Sharpe ratio, they're taught sort of the mathy risk-adjusted performance idea, but then they skip the whole thing about portfolio construction and how to do it easily and cheaply. And they just don't know it. An says, aren't Ivy League professors, aren't they professionals in hedge funds? Some are not. Some are not. Many of them are consultants. So you might you might run a big hedge fund and you have a lot of money because you know a lot of rich people. But then you want to move to the next level and you want to kind of bring in institutional clients, and you're like, well, I need to borrow from somebody else's credibility and maybe someone that already knows these institutions. How do I do that? And you're like, oh, well, you hire a Harvard professor to sit on your board of advisors. You pay him $500,000 a year to do 3 Zoom calls per year. And you leverage the heck out of their name and the fact that they're a famous Harvard professor. So then when you're pitching an endowment fund, they're like, why should we give you some money? You're like, well, I have this Harvard professor on my board. Oh, well, I guess you're legit. Meanwhile, they're making bank on that kind of stuff. Oh, is that right, Morgan? Morgan Taylor, like this master's degree in finance and investment. Yeah, right on. Right on, Morgan. Cool. Yeah, I'm being a little strong on the idea, but I'm telling you, maybe hedge fund managers are kind of different, maybe. But when you look at the wealth management industry, there's very little requirement to manage other people's money. Nobody says, do you have an economics degree or a finance degree? No. Do you know how to construct a portfolio? No. Oh, okay. Would you like to work at our firm? Your job will be to go out, find poor people that don't know how to make financial decisions. And if you're 1% smarter than them, they'll give you their retirement money and you can, earn 1% of their net worth. You're like, whoa. The requirement for that job is, can you go out and raise money? Are you a salesman? Yes. Okay, you're hired. Do you know anything about stocks? No. Do you know anything about finance? No. Do you know anything about economics? No. Do you know rich people? Yes. All right, you're hired. And that's the sad thing. That's the one major point that I'm trying to make. Maybe hedge fund guys are different. Yeah, I suppose if you have an MBA, yeah, maybe you do know, but I bet you many still don't understand. So right on, Morgan. So hopefully I reinforced it in such a way that you now know, and you know the importance of knowing. And I think many universities say, read this stuff, do this homework, submit it, and it might be on the exam. So you do the reading, you do the homework, you get your grade, you pass the one question on the exam, and you're done. You're like, I'm done. But you don't know why you were taught. They've never taken the time to just say, this is what Bill Sharp was trying to convey. You might be able to calculate the Sharp ratio. And you're like, well, which Sharp ratio? Yeah, okay, great, right? Like, because now there's 9 different Sharp ratios. Right, Morgan? So hopefully I've complimented your MBA or your master's in finance. Hey Morgan, are you still there? I have a pop quiz for you. If you're still here, I'll test you. Yeah, okay. Sorrentino ratio, do you know that one? I bet you had to calculate that. All right. Bill Sharp, I don't know Sorrentino. So Sharp and Sorrentino are working together. Sharp is already somewhat famous. And they're working together on the Sharp ratio, which is now known as the Sharp ratio. It was never called the Sharp ratio. It was like the risk-adjusted performance ratio, in which Sharp and Sorrentino were working together. So Bill Sharp's a lot more famous. They write the paper. His name is first on the paper, alphabetical. Okay? And it gets published, and Bill Sharp becomes super famous, wins the Nobel Prize. I think Sorrentino got the Nobel Prize, but nobody interviewed him. He didn't go on TV, didn't get any magazines, didn't get any high-paying consulting jobs. And then everybody refers to his work as the Sharp ratio, not the Sharp and Sorrentino ratio, right? Yeah, Peter's getting there, right? So anyways, so Sorrentino's like, don't, son of a... So he gets all pissed at Sharp, and he goes off his own to create a new paper. And he says, look, there's a flaw in the Sharp ratio. He quietly forgets to tell everybody it was his flaw. See, he did the work. In fact, he may have done more work than Bill Sharp, but Bill Sharp is super famous. Now, in this case, they're teaching Morgan the Sharp ratio, but not the Sorrentino ratio, right? Oh, that's Sorrentino getting stabbed in the back again, right? So you can imagine, right, that Sorrentino's like, oh my God. So anyway, Sorrentino goes out and says, look. The flaw with the Sharp ratio is that it looks at returns over vol, right? You want consistent returns with low volatility, right? Everything I've been teaching you. Well, here's the problem, he says. Wait, Sorrentino says. There's good vol and there's bad vol. When the stock market is going in your favor and you're making money hand over fist, that's good. But when the market is crashing and going against you, that's bad. Sharp ratio doesn't distinguish between the two. All vol is bad. Okay? So Sorrentino says, no. And he looks at the good vol versus the bad vol, tries to put that into the mathematics to give you his ratio. So it's not just pure risk adjusted performance, but it's downside risk performance. Bravo! Bravissimo! Oh man, the history of finance, huh? Now, wouldn't it be cool if your university professor could put everything into context? So you're like, oh, I know that story. Like maybe you can already get a sense of the characters that are in play, right? Like these are real people doing real mathy things for real outcomes that actually impact the world of finance and investing directly. And it's used all day, every day by professionals that don't understand the context. So I hope you love it. Like I geek out on this stuff because I have a love and a passion for what I do. And if you ask me, I want to know everything. Cool. So anyways, thin markets today. Yens are weak. Gold's making a run. Life is good. So if you don't mind, could you click the thumbs up button and let YouTube know this was, half decent? This was not a waste of your time. And I'll see everybody in my day trading group at 4. And for everybody else, I'll see you tomorrow in the AM. Okay? So thank you for being in our community. And thank you for the hard work and effort that you put into this, your positive energy that you share every single day. I really do appreciate that. So thank you for being part of the Forex.Today community. And remember, check out those links in the description below. They're real resources that will make a difference. So I'll see you soon. Cheers. Boop, 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 boop. Bah.